Welcome back now to scenario C. This time we have Christine, who starts off with 1,500 in the bank. Christine goes away and buys her 1,000 cans of Coke for €1 each for cash. This time Christine says, I'm not going to pay money renting stalls. I can buy my own stall for 1,500. And she thinks, I'm going to get about 3 years out of that, and I'm going to go for 10 matches a year. So I'm going to get 30 matches use out of that stall. So she goes to her football match and she pays her permit. She has no stall hire. And then she sells her cans at €2 each for cash, which would be 1,200 revenue. Now, the important thing here that we're going to look at, Christine has a stall for 1,500. It's a cost. If I put it into her profit and loss, the full 1,500, it's going to destroy her profit and loss because she's only selling for 1,200. So she's going to be, down 300 before you even take into account the 50 there. So she's going to be down. And the reality is that that stall is going to last her for 3 years. So is it fair to charge one match or even the first 10 matches for the cost of that stall? And the accountant says no. The accountant says if that stall is going to last for 3 years, I should spread the cost over 3 years. If the stall is going to last for 30 matches, I should spread the cost over 30 matches. So if I spread that cost over 30 matches, that'll be €50 a match. And that's kind of a measure of the wearing out of the stall. And the accountant calls that depreciation because he'll never use a simple word where you can find a bigger word to use. So we'll have €50 depreciation. The other thing we have is Christine will have something and it's going to last for 30 matches. So she'll have an asset. And because it's an asset that doesn't turn into cash easily, or that's not easy to turn back into cash, we call it a fixed asset. Again, complicated, but we put a fancy word in it, so we have a fixed asset of 1,500. So let's look at her balance sheet. Christine starts off with 1,500 in the bank and nothing else. And again, capital account. Christine starts off, the business owes her back the 1,500 that she puts in, so the business owes back the 1,500. And at the start, she's done nothing, so she's no profits. This time, Christine has sales of 1,200, which is a 600 cases at €2 a piece. She has cost of goods sold, the cost of the items that she sold. She sold 600 cans and they cost her €1 each, so that's 600. She spent €50 on her permit going in. And this time we're showing a depreciation cost. The depreciation is a measure of her use, of the wearing out of the stall. And we said it's 1,500 divided by 30 matches, so that's €50 a match. So now Christine is making 500. So we can see that if she was to rent the stall, she'd have paid 100 for it. If she has a stall and she realistically is going to get 30 matches out of it, it's only going to cost her 50 per match. So she's saving 50. So compared to the last few profit and losses that we've looked at, she's up 50. They had 450, she's got 500. Let's look at the closing balance sheet now. Christine has an asset that she paid 1,500 for, so we'll show that as fixed assets at cost. We want to recognize that she's used it for one match, so it might have got a bit scuffed or damaged or whatever, but we recognize a bit of wear out of it. So €50 there, so we put that in. She's got stocks of €400. She's got 400 cans left, and they cost her €1 a pop. They paid her on time, so she's not owed any money. And this time, we'll look at the calculation of the cash in a minute. So looking at the cash, she took in 1,200. She spent 1,500, and she spent 1,000, and she spent 50. So add those up and you get 3,750. So you don't actually get 3,750 because I shouldn't be adding our inflows and outflows. She's got 2,550 minus 12, which is 1,350. And so her cash deteriorated by 1,350 because what happened, she took the 1,200 in, but she paid out 1,500 and 1,000. And she paid out the 50. And she had 15 to start with. So she had 2,700 to start with. She paid out 15, she paid out 1,000, and she paid out 50. But her cash went down by 1,350. So her final bank is going to be 150. So what we can see there then is that She's got assets now worth 2,000, but she's got liabilities and equity of 2,000. The business owes back the original 1,500, and the business owes the 500 profit she made. So she's owed 2,000. That 2,000 is sitting as a fixed asset worth with a net of 1,450, 1,500 less 50. Stocks of 400, so that's 1,850 in total. And then the bank, another 150 at 2,000. So her assets are made up of those items. So we look at it again. Opening balance sheet 1,500, closing balance sheet 2,000. The increase is 500, which is expressed by the sales less the expenses. She made 500, but her cash went down by 1,350. Main reason for that is because she bought this fixed asset, but you need to watch your cash. You need to understand that profits and cash are not the same. So that's our third scenario, the Christine scenario. I'm going to break the video here again now, and I'm going to come back with scenario D.